Florida has a housing time bomb and 2026 could be the blast. Imagine opening a letter from your building and seeing a $20,000 bill due in 30 days, while your insurance jumps again. Sounds extreme? It's happened to real owners, and new rules make these shocks harder to dodge. Starting in 2026, condo communities must put cash into reserves for structural repairs, not just talk about it. Translation: fees can surge, special assessments can land overnight, and buyers may run. If you're renting, don't relax. Those costs often roll into rent hikes. Here's the scary part: it won't feel like an eviction. It will feel like math: pay or sell, upgrade or fall behind, renew or get dropped. In this video, I'm breaking down 10 key 2026 changes and steps you can take now today to protect your home, your wallet, and your peace of mind before the next notice hits your mailbox. Number 1. Condo reserve funding becomes real money. For decades, many Florida condo buildings survived on a dangerous illusion. Associations were allowed to waive or underfund reserve accounts, the very money meant for concrete repairs, roofs, plumbing, and structural safety. Boards often chose the easy path: keep monthly fees low today and worry about repairs later. But in 2026, that later officially arrives. New requirements mean reserve funding is no longer optional on paper. It must be real cash, set aside and protected specifically for structural items. For many buildings, this will be the first time they confront the true cost of staying safe and compliant. Here's where the pressure hits homeowners hard. When a reserve study reveals millions in needed repairs, associations don't have many choices. They either raise monthly fees sharply or issue special assessments, sometimes $10,000, $20,000 or more per unit, due in a short window. For retirees, fixed-income owners, and middle-class families already struggling with insurance hikes and inflation, this can feel like an impossible wall. Not because they were reckless, but because the system encouraged delay for years and now the bill is due all at once. This is why people aren't being kicked out in the traditional sense. They're being priced out by compliance. Owners who can't afford the sudden costs may be forced to sell, often fast and sometimes below market value. Buyers, seeing higher fees and looming repairs, may hesitate or walk away entirely. The result? A quiet but powerful reshaping of Florida's condo market. In the next sections, you'll see why this single change connects to everything else coming in 2026, and why ignoring it is no longer an option. Number 2. Condo websites and online portals become mandatory. At first glance, this law sounds harmless, almost helpful. Starting in 2026, many Florida condo associations will be required to maintain an official website or secure online portal where owners can easily access records. Things like budgets, reserve studies, inspection reports, meeting minutes, and governing documents will no longer be buried in filing cabinets or quietly shared only with insiders. Everything becomes visible. And while transparency sounds like a win, it comes with consequences most owners are not prepared for. Here's the twist: when information becomes public and easy to access, problems surface fast. Buyers, lenders, and insurers will be able to see if a building is underfunded, behind on repairs, or sitting on alarming inspection reports. A condo that once looked fine from the outside can suddenly appear risky on paper. That can lead to failed sales, denied mortgages, or buyers demanding steep discounts. For owners who need to sell to escape rising costs, this visibility can trap them, because the market now sees what was once hidden. For current residents, this change can feel like a spotlight turning on overnight. Buildings with poor management or weak finances may face pressure from owners demanding action that often means higher fees or special assessments. And for renters, landlords facing these costs may respond the only way they can: raising rent or selling the unit. Transparency doesn't create the problems, but it removes the cover. In 2026, ignorance is no longer possible. And for many Floridians, seeing the full financial reality of their building may be the moment they realize staying is no longer affordable. Number 3. Milestone inspections and reserve deadlines collide. This is where timing turns into a financial trap. Florida's milestone inspections and structural reserve studies don't just exist separately, they collide around 2026, and that collision can be brutal. Buildings reaching certain ages are required to undergo deep structural inspections, and when those inspections are due near the 2026 deadline, associations are allowed, but pressured, to bundle them with full reserve studies. Sounds efficient. In reality, it means years of deferred problems can surface all at once, with official reports that can't be ignored, delayed, or negotiated away. When those reports come back, the language is often clinical but terrifying: concrete deterioration, corrosion, waterproofing failure, load-bearing concerns. These aren't cosmetic issues. Once documented, boards are legally exposed if they don't act. That's when repair timelines tighten and funding becomes mandatory. Associations that thought they had time suddenly discover they don't. And because contractors, engineers, and materials are already in high demand, costs are often far higher than anyone expected. For homeowners, this creates a nightmare scenario. Fees rise. Special assessments hit. And selling becomes harder at the exact moment many owners want out. Buyers may walk once they see inspection reports. Lenders may hesitate. Some insurers may pull back. So owners are stuck between paying massive repair costs or trying to sell into a market that now sees their building as risky. This is one of the clearest ways people can be forced out without a single eviction notice. Not because the building is unsafe today, but because the price of proving it's safe tomorrow becomes more than they can afford. Number 4. Florida Building Code 2026 raises the cost of fixing and rebuilding. Most homeowners don't pay attention to building codes until a storm, a major repair, or an insurance claim forces them to. And in 2026, Florida's updated building code quietly raises the bar again. New standards are designed to improve safety, storm resistance, and durability, but they also make repairs and rebuilds more expensive. That means if your home or condo needs major work after damage, you may not be allowed to fix it the old way. You'll be required to rebuild to the new, stricter standards, even if your home was legally built decades ago. Here's where the financial shock comes in. Insurance may not fully cover the difference between old construction methods and new code requirements. That gap, sometimes tens of thousands of dollars, lands directly on the homeowner. For condo associations, this applies across entire buildings, multiplying costs fast. For single-family homeowners already struggling with skyrocketing premiums and deductibles, this can be the final straw. A repair that once felt manageable suddenly becomes financially impossible. This law doesn't push people out overnight, it squeezes them slowly. Owners delay repairs because they're expensive. Delayed repairs trigger insurance issues. Insurance issues trigger lender concerns. And before you know it, refinancing, selling, or even staying insured becomes difficult. Some homeowners will decide it's better to walk away than sink more money into a property that keeps demanding more. In 2026, safety improvements may save lives, but they will also reshape who can afford to own property in Florida at all. This video made you stop and think. Don't keep it to yourself. Drop a comment telling us what law worries you the most, or simply type, "I'm preparing," so others know they're not alone. Watch our previous video next to understand why this crisis didn't happen overnight. And if these deep dive videos help you see what others miss, please support our work by subscribing. It's just one click, but it keeps this channel alive. Number 5. Fire safety rules get stricter and more expensive. Fire safety laws don't sound scary until you see the bill. In 2026, updated fire prevention requirements are set to take effect across Florida, especially impacting older condos and multifamily buildings. These rules focus on life-saving systems like fire alarms, standpipes, sprinklers, emergency lighting, and evacuation access. On paper, this is about safety. In real life, it often means tearing into walls, replacing outdated systems, and bringing decades-old buildings up to modern standards they were never designed for. Here's where the pressure builds. Fire upgrades are not optional once violations are identified. If inspectors flag an issue, associations must act, or face fines, legal exposure, or even occupancy restrictions. These upgrades can cost hundreds of thousands or millions of dollars per building, and that cost doesn't come from thin air. It lands on owners through higher monthly fees or sudden special assessments. And unlike cosmetic renovations, these are invisible upgrades. Nothing looks nicer, but everyone pays more. For many residents, this becomes the tipping point. Imagine already paying higher insurance, higher HOA fees, and higher living costs, then getting hit with another mandatory expense for compliance. Retirees and fixed-income owners are especially vulnerable. Some won't qualify for loans. Others won't have time to save. And when selling becomes the only option, buyers may hesitate once they learn fire upgrades are underway or unfunded. Once again, people aren't being forced out by landlords or courts, but by rules that make staying financially impossible. Fire safety saves lives, no doubt, but in 2026, it may also quietly decide who can afford to remain in Florida's aging buildings and who can't. Number 6. Extended stay and hotel living becomes more fragile. Most people don't realize how many Floridians are quietly surviving in extended stay hotels and weekly rentals. When rents spike, credit drops, or leases fall through, these places become the last safety net. But starting in 2026, Changes to how these properties can remove non-paying or overstaying guests make that safety net much thinner. Operators gain clearer authority to remove occupants faster, and for people living paycheck to paycheck, that difference can be devastating. Here's why this matters so much. Extended stay housing sits in a gray zone, technically not a traditional rental, but functionally a home for thousands of families, seniors, and workers. Under the new rules, if payment is late, documentation is incomplete, or checkout terms are violated, removal can happen quickly. There's often no long eviction process, no months of warning, and no housing court protections like a standard lease might provide. One missed paycheck, one medical emergency, one unexpected expense, and housing stability can disappear overnight. This doesn't just affect the poorest residents. It impacts people in transition, those displaced by storms, insurance cancellations, condo assessments, or home repairs they can't afford. When traditional rentals are too expensive or require perfect credit, extended stay hotels become the fallback. But in 2026, that fallback becomes less forgiving. And when someone is removed, finding another place becomes even harder, because prices keep rising and availability keeps shrinking. This is how housing pressure spreads quietly, one rule change at a time. Not with mass evictions but with fewer second chances. For many Floridians, losing this last layer of flexibility could be the moment they fall out of stable housing entirely. Number 7. 2026 removes key upgrade credits, making homes harder to afford. Sometimes what disappears hurts more than what's added. Going into 2026, several federal home upgrade tax credits that helped homeowners afford energy-efficient improvements expire after 2025. That means starting in 2026, upgrades like insulation improvements, efficient windows, solar-related work, and other cost-saving improvements become more expensive out of pocket. For many Floridians, these credits weren't a bonus. They were the only reason upgrades were affordable at all. Why does this matter for housing stability? Because these upgrades often lower monthly utility bills, improve insurance eligibility, and increase long-term affordability. Without the credits, homeowners face a tough choice: delay upgrades and pay higher bills every month, or pay full price upfront and drain savings. For people already stretched thin, both options hurt. And delaying upgrades can have a domino effect: higher energy costs, more wear on older systems, and fewer options when insurers or lenders start asking questions. This shift hits hardest at the worst possible time. Insurance costs are already soaring. Repair costs are rising. And many homeowners were counting on these credits to help them keep their homes livable and affordable. In 2026, that support vanishes quietly, no headlines, no warning letters. Just higher prices and fewer options. Over time, this pushes some owners toward selling, downsizing, or giving up on ownership altogether. Not because they mismanaged their finances, but because the math no longer works without the help that once made staying possible. Number 8. Roofing rules and insurance pressure could decide who stays. Roofs don't usually make headlines, but in Florida they can decide whether you keep your home. Going into 2026, lawmakers are debating changes around how insurance companies treat roof age, especially when a roof still has life left but hits an arbitrary number on paper. While some proposals aim to protect homeowners from being dropped solely because of roof age, the bigger picture is more complicated. Even the discussion of these rules signals one thing clearly: roof risk is now central to housing survival in Florida. Here's the problem most homeowners face. A roof replacement can cost $15,000 to $40,000 or more, depending on materials and size. Many people are being told to replace roofs that aren't leaking and aren't failing, just aging. If insurance is denied or premiums spike beyond reach, lenders can step in, and suddenly the home becomes unfinanceable or violates mortgage terms. That pressure forces owners to choose between draining savings, taking on high-interest debt, or selling the home entirely. Even if new protections pass, they won't eliminate the pressure. They'll just reshape it. Insurers may adjust premiums, deductibles, or inspection requirements instead. That means homeowners who don't plan ahead could still get trapped. The smartest move in this environment isn't panic, it's preparation. Knowing your roof's actual condition, having inspection documentation, and planning financially gives you leverage. But for owners already stretched thin, roofing becomes another silent push toward the edge. One letter from an insurer, one inspection report, one deadline. And suddenly, staying in your home no longer feels like a choice, it feels like a race against the clock. Number 9. Home hardening incentives may raise costs for everyone else. On the surface, home hardening programs sound like a lifesaver. Grants, rebates, and refunds for upgrades like impact windows, reinforced doors, and stronger roofing systems are designed to help Floridians protect their homes from storms and qualify for better insurance. And in 2026, new refund windows tied to these programs are expected to open. But here's the uncomfortable truth most people won't talk about. Incentives can drive prices up, especially when demand explodes faster than supply. When thousands of homeowners rush to upgrade at the same time, contractors get booked months out, material prices rise, and labor costs spike. The people who don't qualify for incentives, or who miss the application window, end up paying the highest prices. For lower-income homeowners or seniors who can't front the money while waiting for a refund, these programs can actually widen the gap. Those who upgrade get safer homes and better insurance terms. Those who can't fall further behind. Over time, this creates a quiet divide in Florida's housing market. Hardened homes become easier to insure, easier to sell, and cheaper to maintain long-term. Non-hardened homes become riskier in the eyes of insurers and buyers. And when insurance or resale becomes difficult, owners are boxed in. They may want to stay, but without upgrades, staying gets more expensive every year. This is how good intentions can still push people out. Not instantly, not loudly, but slowly as costs rise and options shrink until leaving feels like the only remaining move. Number 10, ADU and property tax changes could backfire on homeowners. Accessory dwelling units, often called ADUs, backyard units, or garage apartments, have been promoted as a financial lifeline. The idea is simple: build a small rental unit, earn extra income, and make your home more affordable. Heading into 2026, Florida lawmakers are pushing policies that encourage more local governments to allow ADUs. On the surface, this sounds like a win for homeowners struggling with rising costs. But the fine print matters, and for some people, it could create new financial pressure instead of relief. The biggest risk comes from property taxes and homestead protections. If an ADU is rented out, some proposals allow counties to separately assess that portion of the property. That can mean higher taxes than homeowners expect, and in some cases partial loss or reduction of homestead benefits. Many owners assume rental income will automatically cover the costs, but once taxes, insurance adjustments, maintenance, and permitting fees are factored in, the math doesn't always work. What starts as a survival strategy can quietly become another monthly burden. This hits hardest for homeowners who build ADUs out of necessity, not investment ambition. Seniors renting out space to stay afloat. Families helping adult children. Owners trying to offset insurance hikes. If taxes rise more than expected, or if local rules change midstream, these homeowners may find themselves worse off than before. And unlike investors, they don't have deep reserves to absorb surprises. In 2026, ADUs may help some people stay, but for others they could be the final straw that pushes costs beyond control. Once again, it's not about bad decisions. It's about rules changing after commitments are already made, leaving everyday Floridians to deal with consequences they never saw coming. By now, one thing should be clear: 2026 isn't about a single law, it's about pressure stacking up from every direction. Reserve funding, inspections, insurance rules, building codes, fire safety, taxes, and disappearing incentives all collide at the same moment. On their own, each change might feel manageable. But together, they create a reality where staying in your home becomes a financial test many people were never prepared to take. This is why so many Floridians won't be evicted in the traditional sense. They'll be priced out, assessed out, or regulated out. What makes this especially painful is that most affected homeowners did nothing wrong. They paid their mortgages. They followed the rules. They trusted that costs would rise gradually, not all at once. But 2026 changes that timeline. Expenses that used to be delayed are now mandatory, transparency exposes problems instantly, and insurance pressure removes flexibility. For retirees, fixed-income owners, and working families already stretched thin, there may be no room left to absorb another hit. When the numbers stop working, selling becomes the only option, even if it means leaving a home they plan to stay in for life. The goal of this video isn't fear, it's preparation. Knowledge creates options. If you understand what's coming, you can ask better questions, plan earlier, and avoid being blindsided by a letter, a vote, or a deadline. Some people will adapt and stay. Others will choose to leave on their own terms instead of being forced later. And that choice, having control, is everything. If this video helped you see the bigger picture, subscribe and share it with someone who lives in Florida. And tell me in the comments, are you in a condo, a house, or renting? Your answer could help shape the next video, because what's coming next may affect you even more than you think.